My name is Lori Schock. I'm the Director of the Office of Investor Education and Advocacy at the United States Securities and Exchange Commission. Before I start talking, I have to give you my typical disclaimer that the views I express here today are mine and mine alone and don't necessarily represent those of the Commission or the staff of the Commission. Everyone has to give that disclaimer except for one person. Guess who? The chair. That's right. So I'm not the chair, so I have to give my disclaimer. I was asked to talk about evaluation of investor education programs in the United States. And this is actually a very timely topic for us because it ties into one of the studies that was required under Dodd-Frank. In 2012, we released our study to Congress that looked at the investor literacy of Americans. And there were 6 different parts to the study. I have until 5 o'clock to talk, is that right? No, just kidding. No, okay. I've got 30 minutes to go over this, so I'm just going to focus on one part of the study, and that was Section 5, that dealt with the most effective private and public efforts to educate investors. As part of the process, we put this out for public comment, and we received over 80 different public comment letters, and the letters came in from a wide variety of sources. They included investors, financial professionals, industry groups, NGOs, also other regulators, whether they were SROs, self-regulatory organizations, state securities regulators, and then also academics weighed in on this as well. And so I want to talk about some of the programs. We're going to look at sort of 3 case studies. Someone said earlier that they wanted to hear case studies. Well, guess what? Lucky you, we'll talk about 3 of them. But the overall theme of the Dodd-Frank study and what we were required to put out looked at the characteristics of effective investor education programs. These won't come as a surprise to anyone here. You have to have focus on your clear goals. You have to have timely and relevant information. They have to cover sort of the important investor education concepts. An investor education program that doesn't talk about risk, fraud, or fees probably is not including the important concepts. It must be accessible to everyone. Promoted with strategic partnerships. We can't do this alone. We all work on limited budgets, so the more that we can work together, I think the better it is to disseminate this information. They have to be scalable, so what works in one part of the country can work all the way across the country. And then efficiency and delivery. You know, we were talking at lunchtime about millennials, and if I were to put anything on paper and serve it to millennials, they would just throw it in the trash, I think, or chastise me for wasting paper because they want to have it electronically. We know that's sort of their mode of delivery. However, when I'm working with seniors, we need to have some paper still available. And then finally, the last part of effective programs includes research and evaluation, and that's the part I want to focus on here today. So the first case study, and I'm going to go ahead and do a different disclaimer for this part, because I'm talking about programs that the SEC doesn't necessarily participate in. I'm not saying that we endorse these programs, but I thought they would be of interest to you. And the first one is the stock market game. How many of you are familiar with the stock market game, or maybe even use it in your jurisdiction? Okay, we have one. All right. So the stock market game has been around almost for 40 years in the United States. It's actually run by the Securities Industry and Financial Markets Association through their foundation, but SIFMA essentially is the collection of broker-dealers in the United States. And so through their NGO, through the foundation, they run the stock market game. And essentially it's a stock simulation game for children in grades 4 through 12. So far, more than 13 million students have been through the program. And essentially what they have is a virtual portfolio of $100,000. And the children trade this during either 10-week, 15-week, or year-long trading sessions. Also, there's a core curriculum that goes around that talks about risk, diversification, causes for stock price fluctuation, sort of buy, hold, and sell strategies. But there was always a criticism, sort of well, maybe this isn't teaching the right thing. Maybe we're teaching the children to gamble. 10 weeks is too short of a time period to actually be investing in stocks. 15 weeks is too short. Some argue even a year is too short. So the kids who take the most risk, may have the most reward. And how do you end up taking too much risk? Well, you don't diversify. You don't do this. And so there was always sort of there were critics out there of the stock market game. So eventually, SIFMA decided, hey, you know what? We want to have the gold standard of evaluation, and we want to have an independent third-party come and do an evaluation of our program. And I give them a lot of credit for that because, that could come out very positively for them, or they're taking a risk that it could actually validate maybe some of those other criticisms that they'd had over the years. So they applied for a grant from the FINRA Investor Education Foundation and received $485,000 to do an evaluation. It was a 2-year independent evaluation. It was a randomized controlled trial. Essentially, they took 600 classrooms. About half of those the students had not participated in the game, and about half of them, the students had participated in the game. And so they essentially had 3 different instruments to complete. One was a math test, financial literacy test, and then a survey. And so again, not knowing the outcome, they took the risk and went ahead with this process. Like I said, they used an independent external third party that was well known for doing this type of research. So the findings actually were very interesting and also spoke very well for the game itself. Because the improvements in mathematics, especially for the younger students who were in 4th to 6th grade, were 12 percentile points higher. For 7th and 10th graders, that amount went up by 8 points. Improvement in financial literacy, the difference between elementary students going from the 42nd percentile to the 68th percentile is just that's a home run all the way around. The middle school and high school students both went from 40 to 42 into the 58th percentile. Again, very high scores for having gone through the stock market game, which wasn't necessarily focused on mathematics. It wasn't focused on financial literacy. Again, it was a stock simulation program. However, these are the results that they had. Additionally, the teachers themselves were surveyed. And what they found from the teachers is there was actually behavioral change in the teachers. Someone mentioned earlier that the trainers weren't very comfortable in teaching this information, and a lot of that discomfort comes because they don't feel as though they have the knowledge and skills themselves and may not practice it themselves. And they found the same thing with the teachers, but the teachers who actually taught the stock market game had a major influence in their own personal financial behaviors, and so they did set goals for their financial for their financial goals. They analyzed their risks, and then also they paid more attention to the media and what was happening with the markets, what was going on. When people sort of bury their heads in the sand, oh, it's bad news, I don't want to hear it. But the teachers were actually more engaged, whether it was reading the business section of the newspaper or following it online. They were just more engaged in the process. The second case study, I have a little bit of a different perspective on this one. Whereas the stock market game had been in place, like I said, for almost 40 years before it was evaluated. This is the FINRA Investor Education Foundation put out an investor protection campaign, and it's the Outsmarting Investment Fraud. It was targeted to 55 to 65-year-old people, but this was a campaign that came out because of previous research that the foundation had done. The 2006 research actually sort of shattered the stereotypes of what and who we thought were the investment fraud victims in the United States. For the older population, I think we thought it was going to be generally women who were probably widowed or lived alone. Someone called and had a sales pitch, they took the bait, they invested. Well, that wasn't the case at all. Actually, we found that, generally speaking, it was about a 2 to 3 ratio here, that more than likely it was going to be a man who was married, who was college educated, scored higher on financial literacy concepts, had been successful in his job or business, but part of that was he went with his gut, and that gut check often was wrong, and they weren't willing to independently verify information. And so not being able to address those persuasion tactics that were used by the con artists, or even know that those were persuasion tactics, FINRA looked at trying to develop a program to address these issues and to use sort of the social norm type program. So in 2008, they did a pilot that focused on the risk factors of learning to spot persuasion. And essentially it was the risk, persuasion tactics, and then how to protect yourself. And the motto or logo of the campaign was actually very simple. Before you invest, ask and check. It sounds like a simple program to do, and that ask actually was a little bit more difficult, I think, than what they were looking for. But so as they were developing their program, they did a lot of research on the front end. It was field tested in 2008 and in 2009, and essentially they were looking to gauge the effectiveness of the curriculum in increasing resistance to investment fraud. And the way that they did these tests, and these were geographically dispersed, they called people to pitch them an oil and gas scam, essentially. If the person gave their personal information for them to mail materials to them, they took that as a failure. Okay, so that was sort of the threshold. So if you were open to the pitch, you gave your personal information, your name, address, for them to mail you the information, that was essentially a failure. And then the people attended the seminar, and then after the seminar, people were called. So prior to the seminar, 35% of the people were open to the sales pitch. After attending the seminar, only 17% were open to the sales pitch. So there was a 50% reduction in just even being open to the sales pitch. And so that was testing for the efficacy of the message, and shutting it down to where you didn't give out personal information to take the sales pitch. And I have to tell you that the person that they used to make the phone calls actually was someone who in a previous life had pitched oil and gas scams. So he knew the drill quite well. During my time when I actually worked at FINRA, I sat with him in the room, and he was a master on the telephone. It was incredible what he could say to people and how he could get them to turn. Well, don't you make decisions at home? Or don't you make decisions at your job all day long? Why do you need to call your wife? You can do this today. And it was amazing. It's like, no one's going to fall for that. And sure enough, people did. So that was the beginning of the test and testing of the message. In 2009, they wanted to continue to see sort of the persistency for the message. I am not a researcher by background. So I think today we're bankers rated on the scale. I was actually a few notches down as attorney, so I'm not sure why that is. But anyhow, but I understand from the research and researchers that if people still have recall of your message 2 to 3 weeks later after having heard it, that is almost like a lifetime. That it's incredible if people can actually recall what the message was. And so again, the foundation went and tested for persistency of the message. So they set up the same trial again, got people to sign up to come to a seminar. Called them before the seminar, then cold called them after the seminar. And so they found that the message had stickiness. There was again a 50% reduction in the uptake in giving out that personal information, and people still retained the information, or still had the behavior that they were looking for. So that was very good. So when I went to the SEC, why recreate the wheel? The SEC has worked together now with FINRA in the Outsmarting Investment Fraud campaign for the past 5 years. We will continue to do so unless some major thing happens and we get rid of all fraud in the United States. So that is actually a program where we work jointly with FINRA, AARP, which is a very large seniors organization in the United States, and state securities regulators. So the third case study is sort of an evaluation of websites. In 2009, the SEC launched investor.gov. We set it up as a microsite instead of having our investor education materials solely on sec.gov, and that was due to some of the comments we'd received from the investing public that it was difficult to find our investor education materials. So this website is totally dedicated to investor education. And with this, you saw the first one, the sort of the gold standard of evaluation, and the cost for that was $485,000. FINRA probably spent close to $150,000 for the Outsmarting Investment Fraud campaign to start up. I know what that would do to my budget at work if so I wanted to make sure, because more than likely everyone's going to have a website, and how you can use the evaluation of your websites as well. Last year, our fiscal year just ended September 30th, so this is fairly current data. We had over 1.3 visitors to investor.gov. We also then had over 1,400 people who took the survey. Our survey has some standardized questions, but then there's also an opportunity to put in sort of ad hoc responses. And so one of the behavioral questions, did you learn something on investor.gov that might impact your behavior in the future? 57% said yes, 21% maybe, 22% no. So it just gives us a little bit of feedback. And then from that, we also have the open-ended questions that people, when they tell us, what did they learn? Okay, I better understand mutual funds and variable annuities. That's good. We want people to, enhance their knowledge of products. That's an important part of what we're trying to educate investors on. I learned I can check the background of financial advisors. That's a home run for us. That's a good thing because that's one of our core messages, especially for anti-fraud. And then the effective compound interest. They're using one of our tools. There's a compound interest calculator. And so, did the site help you do what you wanted to do today? And so 76 said yes, 14% partially, so I'm up to 90%. 6% said, hey, I wasn't really looking for anything in particular, and 4% says no, which those are pretty good stats all the way around. And for a government website, it's actually a very good stat. Our annual cost for this is about $30,000. We use a company called Forsey, which is used across the government, but also a lot of industry and retail websites use this. We scored so high on our Forsey scores that a major magazine listed investor.gov as one of the top 5 government websites that people actually use. So we took that as a very positive thing as a regulator. And it was just, investor.gov continues to evolve, but I just sort of wanted to give you this broad spectrum of different programs that reach different audiences and sort of the cost associated with them. As Adele said, it's important to have research and evaluation built into your programs. And if you can't buy it, work with someone else who can, seems to be the other, part of what I wanted to share. And that's what we've done, using our partnerships to reach target populations and sort of amplify these messages. With the seniors, we do work with the FINRA Investor Education Foundation. With teachers, we work with the Jumpstart Coalition for Financial Literacy. Those are state coalitions that work at educating teachers who teach financial literacy concepts in the schools. Because in the United States, when it comes to getting into the school system, that's not a national issue. It's not even a state issue. It is literally at the local school district level. So we need all the partners we can get. And then also, we'd done a joint program with the New York Stock Exchange for the SEC graduate program for teachers. We've done that for the past 4 years, and we're getting ready to change and work with Jumpstart through their Teacher Training Alliance. It's just a way for us to leverage where we'll reach hundreds of teachers on an annual basis, whereas we were reaching a little under 100 each year with the SEC graduate program.